Here is the snowball you built your entire life. 30 years of contributions, compound growth stacking on compound growth. You hit your number at 55, $1.2 million, and you pick it up. You stop rolling it. You cash out. You retire. And 5 years later, the person sitting next to you at every financial planning seminar, the one who kept working until 60, has a portfolio worth almost twice yours. Same market, same index funds, same average annual return. And they're pulling more money per year than you are, paying less in taxes than you did, getting a larger Social Security check, and they've never once paid a $14,000 annual insurance bill just to cover one person before Medicare kicks in. Here's what the early retirement community doesn't say out loud. Retiring at 55, when you do the math from all four directions at once, is one of the most expensive financial decisions you can make. Not because the dream is wrong, because the timing destroys the math in ways that don't show up in any retirement calculator you've ever used. And I'm going to show you exactly how much it costs year by year with real numbers so you can decide if the 5 years are worth it. The central metaphor I keep coming back to is the snowball. Not because it's clever, because it's physically accurate. A snowball rolling downhill doesn't grow linearly. It grows exponentially, and the bigger it gets, the faster it grows. When you stop it at 55, you're stopping it at exactly the moment the growth rate is starting to compound hard. A $1.2 million portfolio at 7% annual return adds $84,000 per year in growth without you touching it. At $1.8 million, which is where you'd be 5 years later, it's adding $126,000 per year. You're picking up the snowball right before it becomes a boulder. And then you wonder why the guy who waited ended up with more. The snowball isn't a metaphor I'll use once. It comes back because every layer of this argument is another way that stopping the snowball early costs you. In a few minutes, I'm going to show you the most counterintuitive number in this whole conversation. It has to do with how the federal government calculates your Social Security benefit and why stopping work at 55 might literally lower your monthly check for the rest of your life. But first, let me show you the bill that almost no retirement calculator accounts for. Here's the thing. Most retirement planning tools do not model. Between the ages of 55 and 65, before Medicare begins, you are entirely on your own for health insurance. This is not a minor inconvenience. In 2026, after the enhanced ACA premium tax credits that had been in place since 2021 expired without renewal, a 62-year-old buying a marketplace plan in most states pays over $1,500 per month for single coverage if their income exceeds roughly $62,600. That is the subsidy cliff, and it hits early retirees with investment income harder than almost anyone else. The enhanced premium tax credits that had lowered ACA premiums since 2021 expired at the end of 2025 and were not renewed. For early retirees, this means the subsidy cliff at 400% of the federal poverty level is back. So anyone earning above roughly $62,600 as a single person in 2026 pays full price for marketplace coverage, which can exceed $1,500 a month at age 62 in some rating areas. If you're a couple without Medicare, private insurance can cost $1,500 to $2,000 a month for a couple. That is $18,000 to $24,000 per year in premiums alone. Not copays, not deductibles, not the prescription costs, just the monthly premium. Paying about $12,000 to $13,000 per year in premiums per person can consume a notable portion of annual retirement income, particularly for households relying on withdrawals from savings or investments. Now run that math over 10 years. If you retire at 55 and Medicare starts at 65, a couple is looking at $180,000 to $240,000 in insurance premiums. That is before a single hospitalization. That is before inflation. Medical inflation has historically run faster than general inflation, so the number compounds upward every year. And here is the thing that makes this brutal. That healthcare spending is coming directly out of a portfolio that is simultaneously being damaged by every dollar you withdraw. Because when you sell shares to pay an insurance premium, you're not just losing that dollar, you're losing all the future compounding on that dollar. You're stopping the snowball from growing by more than the premium itself. If you're drawing heavily from your 401k, those withdrawals count as income potentially pushing you out of eligibility for ACA subsidies. So the act of funding your retirement can destroy the income thresholds that would have reduced your insurance costs. It's a trap with two walls. Think about Gary, not a real person, but a composite of every conversation I've seen in early retirement forums. Gary hit $1.5 million at 55. He ran every calculator. They all said he was fine. He retired. What Gary didn't account for was that his withdrawal rate for living expenses alone was about 4%, which looked fine on paper, but Gary also had to pay $26,000 a year in insurance for himself and his wife, which pushed his real annual burn rate to 4.2% of his original portfolio, above the safe withdrawal rate threshold. And that was in year 1. By year 3, Gary was quietly wondering if he'd made a mistake. You think Gary's problem was that he didn't save enough. His problem was actually the 5-year window between when he stopped working and when Medicare arrived. Stay with me, because this next part changes everything, and it's the reason I've been talking about the snowball. Let me tell you exactly what working from 55 to 60 actually does to your financial position. 3 things happen simultaneously, and they stack. First, you don't draw down the portfolio. At 4% withdrawal on $1.2 million, Dave, who retired at 55, is pulling $48,000 per year out of the portfolio. That's $48,000 per year that stops compounding. Over 5 years before you even consider market returns, that's $240,000 removed. Gone. Second, the portfolio keeps growing. If you're 50 with $1.5 million saved and apply a conservative 7% return, your portfolio grows over $100,000 a year without you adding a single penny. Even if you paused contributions, you'd still reach $2.4 million by 60. That's the power of compound interest after 50. Third, and this one is underutilized, you keep adding contributions during the peak catch-up years. In 2025, those age 50 or older can contribute an additional $7,500 to their 401k plan each year, up to $11,250. For those age 60 to 63, thanks to the Secure 2 Act. That age band 60 to 63 gets a super catch-up contribution that doesn't exist at 55. 5 years of maximizing that provision represents tens of thousands of extra dollars piled onto a portfolio already growing at 7%. Let me put real numbers on this so it's not abstract. Mike, same age as Dave, same starting portfolio of $1.2 million. He works 5 more years, adds $25,000 per year to his accounts, and earns 7% annually. At the end of 5 years, his portfolio is worth approximately $1.83 million. Dave's portfolio, after 5 years of 4% withdrawals and those same 7% returns, he's down to roughly $1.29 million because withdrawals offset most of the growth. The gap between Dave and Mike after just 5 years, $540,000 on the same original investment in the same market, that is the snowball. You left it rolling for 5 more years. And now it's a different snowball entirely. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now. This is where the mainstream retirement narrative has genuinely failed people. The gap between knowing this math and actually building a system around it, those are 2 very different things. I know because 5 years ago I had the data and I still didn't have a framework. My accountants laid out the sequence of returns risk, the withdrawal rate math, the healthcare gap. But knowing facts doesn't automatically produce a plan. So I built one. I spent the better part of a year going through 50 years of actual retirement data, not opinion, not blog posts, and distilling it into a framework I call the exit code. It's a digital book, 8 chapters of pure research, no filler. 2 things in particular are directly relevant to what we're talking about right now. The first is what I call the invisible bill. It's the insurance gap, specifically the $14,000 per person annual cost that destroys early retirees before Medicare starts. I model exactly how this interacts with your withdrawal rate in different portfolio scenarios, and the numbers are alarming in ways a standard retirement calculator never shows you. The second is something called the 58% rule, which describes the percentage of workers who end up exiting the workforce sooner than they planned. Not because they chose to, but because of a layoff, a health event, or a family care situation. Understanding that stat completely changes how you structure your buffer and your timeline. Because the question isn't always, should I retire at 55 or 60? Sometimes it's, what if I get pushed out at 58 and haven't planned for it? A 2024 Transamerica survey found that 58% of retirees ended their careers sooner than they had planned. Among them, 43% cited employment-related issues. The exit code also covers a dynamic withdrawal method that replaces the static 4% rule for people with longer horizons, plus a Social Security bridge strategy specifically designed for the 60-year-old retiree who wants to delay claiming until 70 without running dry in the interim. It costs less than a dinner out for two through the link in the description. Now, where were we? Gary is wondering if he made a mistake, and he's about to find out that the healthcare bill was only the first problem. The second problem is the withdrawal rate math. And this one is the kind of thing that genuinely should be in every retirement calculator on the internet, and mostly isn't. The 4% rule, the most famous rule in personal finance, was not designed for a 35-year retirement. By considering both average returns and unexpected events, the creator of the rule, Bill Bengen, determined that a portfolio made up of 60% equities and 40% fixed income assets should last over 30 years if you withdraw only 4% of the total amount annually. According to Bengen's model, even if you retire just before a financial crisis, the negative effect on your portfolio would be mild enough to ensure at least 35 years of living expenses. But here is the thing Bengen built into his model. He advised that the average American man was expected to live about 15 years after age 65, and the average woman just under 20 years. That's why he used 30 years as his baseline. Retire at 65, live to 95, 30 years. Retire at 55, live to 95, 40 years. The rule was never stress tested for that. T. Rowe Price ran simulations and found that a portfolio that's 60% in stocks and 40% in bonds would have an 87% chance of lasting for 30 years with a 4% initial withdrawal rate. That's pretty good. But a 13% failure rate is still significant. The same simulation found only a 79% success rate over a 35-year period. Think about what that means. An 8 percentage point swing in survival probability just because you added 5 more years to the horizon, from 87 to 79, and for a 40-year horizon. Many researchers now suggest 3.5% for 35-year retirements and 3 to 3.3% for 40 to 50-year retirements. For longer horizons, the 4% rule's historical success rate drops. So here is the practical consequence. If you want $60,000 per year in retirement income, the math at 4% requires you to have $1.5 million. At 3.5%, you need $1,714,000. The 5-year difference in retirement date doesn't change your desired income. It changes the nest egg requirement by over $200,000. Most people who hit their number at 55 calculated that number at 4%. But a 55-year-old retirement isn't a 30-year retirement. It's a 40-year retirement at minimum. The math says 3.3%, which means their actual required number was higher than the calculator told them. This is the trap Gary walked into. His 1.5 million looked great on the spreadsheet, but his actual required portfolio at 3.3% for a 40-year horizon was $1,800,000. He was short by $300,000 and had no idea because every calculator handed him a green check mark. You think the problem is that Gary saved too little. The problem is actually the math was running on the wrong assumption from the start. Here's the thing about sequence of returns risk that almost nobody explains clearly enough. Sequence of return risk focuses on the timing of market drops and how early losses in retirement can reshape your entire income picture. You can average the same annualized returns as another retiree and still end up with very different results simply because your bad years arrived at the wrong time. According to a recent Fidelity report, if a retiree starts with a balance of $1 million and withdraws $50,000 each year, and there's a sequence of positive returns early in retirement, followed by a bear market later on, the portfolio will have a balance of more than $3 million after 30 years. On the other hand, if there are negative returns early in retirement, followed by a bull market, the portfolio would be depleted in 27 years. Same starting balance, same average return, same withdrawal amount. The only difference is the order of the returns. $3 million versus a depleted account. This is not a minor risk factor. This is potentially the single most important variable in whether your retirement survives. And here's why the 55-year-old faces more exposure to this than the 60-year-old. The risk is highest in the first 10 years. The 55-year-old faces this risk zone from ages 55 to 65 on a smaller portfolio, while simultaneously burning through healthcare costs. The 60-year-old faces it from 60 to 70 on a larger portfolio, with Medicare at 65 cutting the insurance drain in half, and with 5 fewer years of total exposure ahead. The S&P 500 fell hard in both 1973 and 1974, while inflation ran at an average of roughly 9.3% annually for nearly a decade. A retiree starting with a $200,000 portfolio would have seen their savings vaporize by about 30% by the end of 1974. Even though the markets eventually clawed their way back, the damage was already done. Those early losses, magnified by withdrawals, permanently crippled the portfolio's ability to last. A 60-year-old with 1.83 million hitting the same sequence of bad early returns is in a fundamentally different position than a 55-year-old with 1.2 million hitting the same sequence. Scale matters. The snowball matters. Gary, unfortunately, retired in a year that the market decided was not cooperative, year 2 of his retirement. He was drawing 4% plus healthcare costs, real withdrawal rate close to 6%, and the market dropped 20%. He watched his 1.5 million shrink to 1.1. He needed it to recover. The recovery came, but it came after he had already sold a much larger percentage of his portfolio at depressed prices to cover expenses. He was forced to sell assets when prices were low just to generate income. Each withdrawal carved out a much larger percentage of his shrinking portfolio, creating a devastating downward spiral that's incredibly hard to escape. By age 60, Gary, who did everything right and retired at 55 with a solid portfolio, had less money than if he'd never touched it. And at 60, the job market wasn't exactly rolling out the welcome mat. The unretirement problem is more common than the financial media acknowledges. The top reasons seniors return to work include the cost of living increasing more than expected at 51%, boredom at 40%, and insufficient retirement savings at 37%. And just recently, since September 2025, 7% of retirees have returned to the labor force, with nearly half, 48%, saying they returned to work out of economic necessity. Only 14% said they returned to work because of a desire to stay active. These are not people who retired without a plan. Many of them had a plan. The plan just didn't account for the 4 variables stacking against each other simultaneously. Now, here is the final layer of this, the one that surprised me most when I dug into the data, and it is directly connected to how the federal government prices your Social Security benefit. Social Security calculates your monthly payment based on your 35 highest earning years, adjusted for inflation. If you stop working at 55, your late career peak earning years, which are statistically your highest paid stop going into that calculation. But the 35-year window still has to be filled. So if you have low earning years from your 20s, which almost everyone does, those years don't get replaced by higher earning years from your late 50s. They stay in the calculation. If you stop working before 62 and have years with little or no earnings, those lower earning years could reduce your lifetime average earnings used to calculate benefits. that can further shrink your monthly check. Compare this to the person who works until 60. Those 5 extra years, often peak income years, push out 5 of the lower earning early career years and replace them with higher numbers. The average benefit calculation goes up. Then, because they have a larger portfolio to draw from during the bridge period, they can afford to wait to claim Social Security until 70, which is when the math really accelerates. If you choose to delay claiming Social Security beyond full retirement age, you see your benefit increase by 8% for every year you delay until age 70. 3 years of delay from age 67 to 70 is a 24% permanent increase in monthly income. On a check already higher because you worked until 60, the average check for a retired worker at 65 is $1,611 per month compared to $2,148 per month for a worker at 70 with maximum delayed retirement credits. The difference is significant. 25% or $537 per month or $6,445 annually. That is $6,445 per year every year for life. Inflation adjusted, guaranteed by the federal government, not dependent on market returns. The 60-year-old retiree who built a large enough portfolio to bridge from 60 to 70 without claiming Social Security early is pulling in $6,445 more per year every year than the 55-year-old who claimed at 65 out of necessity because the portfolio was tight. Over 20 years of retirement, that difference compounds to $128,900 in Social Security income alone, before any investment returns on the difference in portfolio size. Now, the 55-year-old might say, but I get to enjoy the earlier years. Fair point. That is a real argument. But it only holds up if the financial foundation is solid enough to support a 40-year retirement properly funded. If Gary at 62 is working part-time at Costco to cover the insurance gap and recoup sequence losses, the extra years of freedom arithmetic starts to look like it bought him 7 years of anxiety, followed by a return to the workforce. This is not the 55-year-old's fault. Every metric they were handed told them they were ready. But the metrics were running on 30-year assumptions, ignoring healthcare drag, assuming a static 4% rule, and ignoring the Social Security calculation. All 4 of those errors stack in the same direction. They all make 55 look better than it actually is. They all make 60 look more expensive than it actually is. Look, I want to be precise about what I'm saying here. I am not saying don't pursue early retirement. I am saying if you hit your theoretical number at 55, run it through 4 additional lenses before you pull the trigger. And most people are running it through 0 additional lenses because the retirement calculator on their brokerage's website was built to make them feel confident enough to keep the account open. Here are 3 things you should do with this information. These are not generic. They apply specifically to this decision. First, recalculate your required nest egg using 3.5%, not 4% if you're planning a 35-year retirement. The math is simple. Take your annual spending target and divide it by 0.035. If you were planning to live on $80,000 a year, you thought you needed $2 million. At 3.5%, you actually need $2,285,700. The gap between those two numbers, $285,000, is the gap between a comfortable retirement and Gary's situation. Second, model a healthcare adjusted withdrawal rate for every year before Medicare. Take your actual anticipated insurance cost, and in 2026, with the enhanced subsidies gone, that number is not small, and add it to your annual spending target before applying the withdrawal rate formula. If you're spending $80,000 per year in lifestyle costs and paying $26,000 per year in premiums for a couple, your actual annual retirement burn for those 10 years is $106,000. Divide that by your portfolio and check what the real withdrawal rate actually is. For most people who plan on 4%, it looks more like 6 or 6.5%. That is not a 30-year survivable number. Third, build your Social Security bridge strategy from age 60, not 55. A 10-year bridge living off portfolio distributions from 60 to 70 while your Social Security check grows at 8% per year is manageable on a larger portfolio with a shorter remaining runway. The math closes at 70 when the larger monthly check kicks in and reduces your portfolio dependence permanently. A 15-year bridge from 55 to 70 is a very different equation. Longer runway, smaller starting portfolio, and portfolio compounding working against you instead of for you during the bridge years. The person who retired at 60 didn't get lucky. They let the snowball roll. They absorbed the healthcare free ride from employer coverage for 5 more years. They filled their 35-year earnings record with peak income years. They walked into retirement with a portfolio nearly 60% larger than their 55-year-old counterpart and a timeline 17% shorter. The math doesn't care about the lifestyle pitch. It just runs. Gary, by the way, eventually figured this out. Around age 63, after returning to consulting work, he started modeling the bridge strategy. He rebuilt the portfolio enough to delay Social Security until 69. Not a perfect outcome, but survivable. The 5-year early exit cost him an estimated $380,000 in combined portfolio and Social Security income over the course of his retirement. He would very much like that information to have been in his retirement calculator at 55. No single one of these 4 factors, the healthcare bill, the compounding gap, the withdrawal rate miscalibration, the Social Security reduction, would break a well-funded retirement by itself. But they don't arrive alone. They arrive together, simultaneously. And they all compound in the same direction. That is the mechanism. That is what turns retiring at 55 into unretiring at 63. One more year syndrome is a real psychological trap. I'm not dismissing it, but there is a version of that trap on both sides of the equation. There is one more year paralysis, the person who has way more than enough and can't stop working. And there's one less year overconfidence, the person who stops exactly at the line without accounting for the 4 variables stacking against the 55-year-old and stacking for the 60-year-old. The financial industry will never tell you this clearly because selling you the dream of early retirement is better for engagement than telling you to work until 60. The blog post titled "How to Retire at 55" gets 10 times the clicks of why 60 might be the optimal age. The incentive structure only runs one direction. My job is to tell you what the data actually says. Lazy investing built more fortune than crypto memes. And retiring 1 year too early with one wrong assumption in your calculator will cost you more than a decade of bad stock picks. A 2024 report from the Transamerica Center for Retirement Studies found that nearly 3 out of 5 retirees left the workforce sooner than they expected. Most of them didn't plan to. Plan for the version of you that doesn't get to choose.